G'day, money miners. The China commodity theme will continue in this episode. We've got an absolute rip snorter coming in from Japan, and the theme of MMS being the greatest mining contractor in Australia is something that will never end, especially considering they got gear ready to go to move dirt right now. You think open pit, you think MMS.
Goes together.
That's all you bloody need to know, like a glove.
Goes together. This could be the last in our brief series endeavour to China for a little while, Matty, but we'll be back later.
Mate, we're as many episodes as people in the country. It's bloody great. Boys.
Mate, I think we could brand this one with an Indian flag just about.
Yes.
Strong pick.
Yeah, right. So today, money miners, we have Ian Roper from Astris Advisory. Previously worked bloody CLSA, Macquarie, mate. He covers bulks, base metals, new energy materials, and live from Tokyo, possibly the greatest city in the world, mate. Welcome onto the show.
Cheers. Yeah, certainly the good city. Yeah.
Just don't mind lifting up a bit of sashimi while you're there, mate, just to keep a bit of a Japanese feel to it.
Got some takeout for you here.
Boys, you want to give a bit of an intro of what today's episode will all be about?
Yeah, let's rip in. So, Matty, as you know, we've been going on a bit of a China venture, a bit of a commodities broader sort of venture, given all the stimulus chat that we've seen in recent weeks. And this is another one. Ian's been recommended to us by an Aussie fund manager. So thought we'd get in touch and get the overview from a commodity strategist. And that is very much Ian's background. So where I want to start the conversation, Ian, is the stimulus. It's the elephant in the room, the one we have to kind of talk about. And you told me when we were chatting before the call that you'd had a bit of a pick on China prior to the year starting, and then there was a bit of sentiment and perhaps sentiment changing in and around LME week last week or the week before. So I'm keen to hear what you're kind of picking up, how the mood is on the back of this stimulus that we've seen in China.
Yeah, so China's had a really tough year this year. It started at the end of last year. Xi made it very clear that it's unhappy the local governments have just been spending too much money, too heavily indebted. So there was a big clamp down on local government debt, spending, etc., LGF fees, especially the off-balance sheet lending they were using to fund a lot of infrastructure. So there's one key data series I look at, which is the newly signed construction contracts, quarterly data series that was running down 5 trillion RMB, about 10% year on year in Q4 last year. And that was a very clear indication that the infrastructure this year was just going to be down sharply. Yeah. So cement demand's been running down double digits all year. Steel demand's down about 5%. What I call the old economy in China has really been struggling. But that's not the whole picture for China. Back in the 2000s, a super cycle, a rising tide lifted all boats, right? Whereas now China's really seeing a lot of divergence because you've got the old economy, housing, infrastructure, yes, very, very weak. They've just been in decline for the last few years. That's where things like steel demand have suffered especially. But also we've got the new economy, right? China's massive investment in EVs, in renewable energy, and that's where the base metal demand is. And that's why you're seeing this divergence where steel demand running down 5% this year, but aluminium consumption is still growing 5%. Copper demand is going to be up 3 or 4%. So you've got a real kind of split in China between old and new, and that all comes back to Xi's version of Chinese modernization, as he calls it. Xi's new version of Chinese modernization, which is that Xi wants the Chinese to invest heavily on the technology side and upgrading manufacturing, going high end, leading the world in all the technologies, EVs, etc. And you see they're doing a good job on that. Whereas the old economy, that's just something that they're not focused on.
So Ian, given your role speaking with plenty of institutions out there, what are the traders in and around Asia making of the stimulus?
So there's still a lot of skepticism about the stimulus. So China is now very different to what it used to be, right? In the old days, Beijing would say stimulus and everyone would jump and off to the races. 2009, 2016, markets moved very rapidly. This time around is quite different. Now, I'd say the Chinese peoples have been very depressed since COVID, basically. You've had a number of different angles there. Not least, she's the corruption clampdown, right, making life more uncertain, especially for entrepreneurs and business people, finance people. So that's kind of hit a lot of investor confidence within China, both on the manufacturing side, investing side. For the last 20 years, people have been used to wage growth. Jobs were plentiful. People were getting richer all the time. That's really kind of come to an end with the downturn we've had since 2020 and all the COVID restrictions. And so that's where you've got a lot of people that are feeling, my house price is not going up anymore. Wage incomes growth not there anymore, and that's why consumers have been miserable and not spending, and therefore manufacturers have been miserable and not investing in new manufacturing either. So that's the kind of weakness we've been suffering from really since COVID. And Beijing's been trying to cheer people up for the last couple of years, and that's where it's been so different to previously, that the word stimulus has been too overused now. That we've seen numerous little stimuli, I suppose, over the last couple of years, and they're always tweaking housing restrictions and trying to loosen things at the margin, and then it just falls flat. It's not enough to get things moving. So I've been very dismissive of the stimulus headlines that we've seen through the year until this latest one at the end of September, and this really is a shift change. To me, this is very clearly a strong change in direction, where Beijing's just said, look, growth is just too weak now. Consumers are too miserable. They're not spending. Manufacturers are not investing. And we're really struggling to hit the targets here. So yes, the green economy is doing really well, but we still need the consumers to be spending. We still need the manufacturers to be investing and having a more optimistic outlook. So you've really seen a big shift. But at the same time, they're still constrained by Xi's kind of reluctance to go too heavy on the leverage side of things. So this is not like old-fashioned stimulus of, the gloves are off, just print money and spend on anything. So Xi's still determined not to do a bridges to nowhere policy, right? They're not just going to build infrastructure for infrastructure's sake. It has to show some kind of economic return still. And the housing market, that's the big issue. So one fantastic stat on the housing market, since China privatized the housing market in 1999, prior to that, it was all communism, it was all allocated housing. It's only been a private market since 1999. They've actually built more than one apartment for every urban family in 25 years, right? And that's ridiculous. Some of us live in 100-year-old houses in the rest of the world. China's literally built the entire urban housing stock in 25 years. So that's why the policy for the last few years has been, oh dear, look at the demographics. We've built far too much already. We better stop building here. We can't continue at this kind of pace. So it's about better utilizing what they've got and not building so many new ones. So that's why you've seen such a drop-off in housing. The new housing constructions are running at about a third of the peak levels in the late 2010s. So that's, again, something that's not going to come back, right? So they want to stimulate the consumers. They want to get the manufacturers and the entrepreneurs investing and people feeling good. But she's still reluctant to let the local governments spend more money recklessly to boost the housing market and get developers building more apartments. Those bits of the old economy are still things that they're holding back there. And that's where you're getting kind of these mixed conceptions and kind of lack of belief in stimulus, where a lot of people are still looking for the old-fashioned stimulus, infrastructure and housing. It's just not happening. Whereas this new stimulus is all about trying to get confidence back. And personally, I think they'll get there. They'll be able to raise the confidence. You will see consumers coming out now spending more money. Hopefully we'll see a pickup in investment levels domestically. And then for metals, that could well trigger a restocking cycle. That would be the real upside for metals prices. If you then get all of the manufacturers restocking, you then get the traders restocking, you get a lot of belief and excitement heading into Chinese New Year next year that, 2025 is going to be much better than 2024, and off to the races we go.
When you say consumer, are you referring to Chinese consumers or international consumers?
Oh, no, Chinese consumers, yeah. So okay, obviously one of the...
Yeah, sorry. So if that's the case, like how much of China is made up of the low-income Chinese part of the population that is obviously why everything is so cheap to buy here because of the cheap labour? How much of that is made up? How much of China is made up of that group? And if so, because I assume they can't spend much more because they earn nothing. So How does that all work?
Yeah, I mean, the big issue since COVID is that the savings rates are up so much, right? Because, for the last 20 years, you had rising house prices, rising wage growth. People felt they were getting richer and, happy to spend. And then since COVID, you've seen is the savings rates going up and up and up because people just have a lack of belief in the future. They don't see that they're going to be better off in 5 years. So everyone's kind of hoarding cash. Now, the big problems in China that you have are structurally the lack of a safety net, right? That most of the medical system is still private. So you've got to save money in case you get some nasty disease. Most of the education system, you need a lot of private money as well for all the extra, tutoring and different schools and things. So there's a lot of reasons why the Chinese have always been very conservative and tend to save very heavily for a rainy day. So there's two aspects that Beijing can look at to try and get the consumers spending. Again, number one is obviously the confidence factor of get them believing that the economy will be good. You will be able to make more money next year. So feel free to go out and spend today. And the other thing is potentially reforms around pensions, healthcare, education, HUCO reform, the registration system, whether you're in the city or the countryside. So if they can strengthen some of the social safety net, that's certainly something to watch out for as more structural reforms that could try and get the consumers spending more.
Ian, you spoke about making the most of the property that they've got, and that kind of doesn't sound too great for overall demand for commodities. How are you thinking about that?
Yeah, so start of the year, I said that I'm very bearish on the old economy, on infrastructure, on housing. I think steel demand will be down 3% this year, but I still think that copper and aluminium demand will be +3 or so because the green economy is doing. And that's something which, even with the stimulus coming through, I still maintain that split in the economy will maintain, and we'll see a lot of differentiation between different kind of metals consumption in the coming years. So yes, I don't see a rebound in steel demand, for example, next year. I think infrastructure is probably not going to have a similar drop to this year, probably starts to flatten out. Equally, housing's probably not taking another leg down now, but it's unlikely to recover. So steel demand trajectory absolutely doesn't look very impressive. But the renewables build out, the EVs roll out, and then, in terms of housing, the stimulus that you are seeing is all about completions. It's about buying up unsold units for social housing or renovating old units. So that still means, rewiring, installing new appliances, etc., maybe putting solar panels on the roofs. So there's still a lot of metals demand. It's not steel. It's going to be more aluminium, copper, that kind of thing.
Yeah, it's very, very interesting, the whole, China consumer stimulus in China. If you think of it from an Australian landscape, I don't think we need any consumer stimulus for mining companies to know that Grounded needs to build the mining camp. That's you don't need, they just know that is the right thing to do. As we described last week, just from the new law that you have to have a builder with Sicilian background to know that you're going to get the quality, the longevity, the expertise for any piece of infrastructure on your mine site. And that being limited to Grounded only.
You've seen pictures of these camps, Matty. They are the works.
Oh, Jesus Christ, they're bloody...
Extra room, mate, great gym facilities. I just don't think you can beat what can be built by the team at Grounded.
I've actually contacted the Coburn local council and to get permission to knock down my house and get a Grounded camp in to replace it because they're just even better than my house.
Yeah,
that is just the quality of craftsmanship and the attention to detail, Travis, that Paul Natoli and the Grounded team put towards these mining camps is just unparalleled in the industry. So,
get yourself a Crown Plaza out in the bush.
Oh, mate, if you could tow a Hilton up, it wouldn't even be as good as a Grounded camp. So, mate, and we give you direct access to Paul with his email in the show notes. Flick him a message and ask for a bloody best mining camp in the history of mining and camps.
One of the reasons that that the consumer has such sort of negative sentiment towards investing domestically is because a lot of the policy settings have actually created an environment where these downstream businesses are unprofitable because they have to run kind of under capacity, low utilization. There's too many of them that exist because the local governments all have their own steel mill, all have their own lithium refinery in those sort of senses, and hence kind of don't have the efficiencies and aren't necessarily very profitable. How do you think about the risk that the policy setting will actually result in fewer number of remaining steel mills actually being actually operating, and a focus on profitability in that downstream again, and the implications that could have, for example, on the iron ore market?
Yeah, well, that's certainly something that's under discussion at the moment, around should there be another wave of kind of supply side reforms, right? That was very successful there, 2016, 17, 18. And so you saw a lot of kind of redundant capacity being closed, and actually steel mills had good margins there, and commodity prices were generally higher. So there's a lot of people in the industry who are calling for same again, let's have another round of cuts. But at the same time, the central government's conflicted of on the one hand, they're willing to take the pain for the longer term gain. We're not short term kind of politicians just looking for a good story for 1 or 2 years. We're trying to be structurally sound here. We don't want too much debt and too much kind of negativity overhanging the economy. But on the other hand, they're showing a real reluctance to take too much pain. So you've got a huge number of zombie companies in China, right? And the RRR cuts, the interest rate cuts we saw for the banks in this stimulus, that read more like a bank bailout, because the banks are clearly struggling with a lot of unrealized NPLs and just having to endlessly roll over debts. And the government's reluctant to push a lot of companies to the edge and actually deal with the redundancies and the resulting problems, because there's kind of too much pain from that sense that would result there. So they're really stuck between a rock and a hard place at the moment. But I do think there's decent odds that perhaps you will see renewed talk of things like supply side reforms and a push to perhaps close capacity in some of the heavy industries like steel. And certainly the talk of that could help prices, and kind of people hark back to the good old days of supply side reform when they were making big margins and things. So the industry itself is certainly encouraging that talk.
Have you got an explicit view on where you see iron ore over the next 1, 3, 5 years?
Well, iron ore has been a real conundrum this year. I mean, you've seen very strong supply growth, right? Imports in China are going to be up 60 or 70 million tons this year. India's annualizing up from 40 odd million last year to 60 plus. Brazil's had a good year. Australian exports are up decently as well. You've still got some new supply coming in, Onslow and such ramping up. So there's been plenty of iron ore supply. And yet steel demand in China has been running down about 5% this year. Now, obviously, they've been exporting a bit more steel, so keeping the steel production not quite down that much. But still, the iron ore port inventories have been rising throughout the year. There's no shortage of iron ore. And it's amazing to me how the price hasn't been weaker. I've been calling for the price to fall into kind of the 80s all year because, oil prices are quite low, freight rates are not that high, and the grade discounts are very narrow. That's the most important thing for the iron ore cost curve. Mills are not making money. They're happy to buy low grade. So that essentially suppresses the top of the cost curve, which is dominated by all the low grade suppliers. So from that perspective, I've been surprised iron ore's not been weaker. And then, of course, on the back of stimulus, iron ore's the one that's had the biggest move. Now, the problem we have with the iron ore market is the price is just so dominated by this retail trading in Dalian, right? You look at the met coal price, that's entirely a physical market and a very liquid one. You look at the alumina market, that's entirely a physical market and a very liquid one. So those markets tend to be very depressed or very kind of excited, but they definitely reflect physical changes. Whereas the iron ore market is just moves on hot air so much of the time. So that's why our iron ore went from $89 just before stimulus was announced to $114 within days.
Ian, can you?
And like I said, stimulus is not adding steel demand; it's not adding iron ore consumption. So that's just a complete overreaction.
Can you peel into that a bit? This is a comment I've heard a couple of times as we've ventured into the China kind of commentary, and that's the extent to which there is like Chinese retail money that massively influences kind of the short term gyrations of some of these like pretty hefty markets that grab headlines here in the West.
Yeah, so I'm not too sure what the current numbers are on iron ore, but I remember a few interesting comments over the years. I mean, the average holding period on iron ore trades and Dalian was like 2 hours for a certain period. It's a real day trading market. And there was more trading activity in the old days. Certainly, I don't know if it's still current, but there used to be more trading activity in the night session, when the market would open in the evening, than during the day, which again shows it's kind of, retail. People just trading, and I don't know how many of them are trading drunk as well. So that probably accounts for some of the gyrations.
Is this the futures market, Ian? Is this the futures market you're referring to here?
Yeah, the Dalian exchange. Yeah.
Wow, that's amazing. And that's not seen in most other commodities, is that right?
It's extreme on iron ore. Yeah, it's just iron ore is just dominated. The Dalian volume is much, much greater than the SGX volume, which is kind of like the Western trading market. But then even on the SGX volume, I think an awful lot of that's kind of Chinese arb trade as well, following the Dalian moves. Whereas, when you look at the base metals, obviously LME, COMEX, they've still got massive volumes outside of the SHFE market. And so that's where you tend to see the base metals are less volatile, because I'd say you've got more international trading money that's offsetting any kind of retail in China, whereas iron ore just doesn't have an offset. It's that Dalian market just dominates.
If we change tack, Ian, India is a country that a lot of people have spoken about the sort of bull narrative, and you seem to hold that view as well. Maybe I'll just give you a sort of broad angle to start with what you're thinking of India, and then I'm keen to get into met coal specifically.
Yeah, so when I was living in China in the 2000s, there were all these bullish Chindia reports doing the rounds of, hey, India's got 1 billion people that can follow China. And I was always highly skeptical, right? And I went to India a few times in the 2000s. It's nothing like China, nothing could ever get done there, right? It was kind of bureaucracy or land access rights, or there were a lot of problems where just things didn't progress very quickly, power availability, etc. Whereas post-COVID, speaking to a lot of my India contacts and people doing business there, they were saying, wow, things have really changed. Demand's jumped up and it looks really sustainable. So I went there again last year for the first time since 2009, completely transformed. It's amazing. I think Modi's done quite a few important key changes there. Number one, he invested a lot in infrastructure early on. So India hasn't really suffered blackouts, brownouts on the power side since about 2019. Power supply is plentiful, and they're taking the renewables from something like 200 gigawatts to 500 gigawatts by the end of the decade. Massive investment in that, and they're still adding another 80 gigawatts of thermal power as well. So you've got huge investment in power. You've had big investment in airports, like flying around. It feels just like China or anywhere with modern airport facilities. Everything works much better. Roads as well, ports. So you've had a lot of infrastructure investment. Early on as well, Modi did this cancellation of all the banknotes, if you remember that, and they kind of brought all the banknotes into the banking system. And that's helped to eliminate a lot of the corruption, because everyone now has bank accounts, a lot less cash oriented, digital money and everything. A lot of the social handouts now are all digital money or direct into people's bank accounts as well. And if you're paying everything digitally, there's less room for officials to be dipping their hands in as well, less cash being handled. Equally, digitization of government. So they've streamlined a lot of processes, a lot of the forms, documentation, everything now is on a system, it's online. You're not actually going to a physical person needing a stamp or a signature or something. Again, that's removing a level of potential corruption, speeding up the processes with the paperwork and everything. You had bankruptcy reform, a bit of land access reform and stuff. And so India's got a number of key drivers now. So they keep hiking the infrastructure budget. I think they've raised the infrastructure budget a third every year for the last 3 years. This year it's only up 11%, with the budget being a bit more responsible. But they've still got big plans on infrastructure. They're going to electrify the entire rail network. India is already starting to build a Japanese bullet train network. It's the only country outside of Japan that's actually going to have bullet trains. I think the Japanese government's lending quite a lot of the money for that at a state level. But the first one will be up in 2026. So don't know. They'll have to culturally, no more sitting on the roof at 400 kilometers an hour. That'd be a bit of a change, but should be revolutionize the moving around India with bullet trains there. As I said, the renewable energy build out as well, going up to 500 gigawatts by the end of the decade. One of Modi's pledges in the election was free power for all the rural households. So they've already started a program this year of 10 million rural houses getting free solar installations. So people have got free access to power, and then you could charge your electric bike or something as well for free. So yeah, big plans on the infrastructure side. And then the other thing that Modi is doing a great job of trying to attract all the FDI. So saying to people, why don't you move your factories out of China, come to India? So going to the freedom-loving democracies and say, hey, we're a freedom-loving democracy. You should be investing here for security of supply. And then, of course, Modi's at the BRICS conferences as well. Good friends with the BRICS guys, get them to invest as well. So he's doing a good job of kind of being mates with everyone at the moment and trying to attract investment from everywhere. So that's where India is really interesting, because India doesn't really have much of a manufacturing base at the moment. I believe India only produces about 2% of global goods and consumes about 4%. But Modi is really trying to attract all this investment with this Made in India scheme. And you're seeing a lot of big companies starting to put factories in India, big government subsidies encouraging that. So yeah, you've basically got the infrastructure side, the green energy side, and the manufacturing side all being built out. And you put all that together, and it's giving very strong growth rates for commodities demand. So if you think of India versus China today, for steel, India's 140 million tons of steel production versus China at 1 billion. It's about 15% of the size. It's growing at about 10% a year. Whereas the base metals are more interesting. Things like copper and aluminium. India's only about 1/10 of the size of China, but it's growing at a 15% CAGR, which looks very sustainable. So if you think of that for the world, China's 50% of global copper demand growing at 3% a year, then that gives us 1.5 basis points of global growth. Whereas India is only 5% of the world, but growing at 15% a year. That's giving us 75 basis points of global growth. So India actually, in absolute tonnage terms, is about half the size of China already on an incremental annual basis. So it's not just that it's a nice tailwind for commodities. I think it can really start to make a difference now.
Yeah, speaking about the rise of India, I guess who do you think is going to rise first out of India and Reece Petroleum, Australian Earthworks and Haulage?
Reece Petroleum's already risen. India's still rising.
Well, because since AEH is like anytime exploration V2, like anytime exploration, I'd call China, and then
Reece India.
Reece and AEH are probably going to be the India, which probably will surpass China.
Rising at a faster rate.
Yeah.
Yeah.
Wouldn't you think, JD?
I think you've hit the nail on the head there, mate.
The way I see the vertically integrated relationship between anytime exploration and Australian Earthworks and Haulage, like Reece is the cake, Seamus is the cherry on top. That's like between the Earthworks, Haulage, bloody, that can work absolutely remote as like just batshit crazy how remote these guys can work, unsupervised, with any time providing the fieldies and geos to oversee the earthworks, the rehabilitation, the dam building, all with the expertise of Reece's decades worth of bloody earthworks experience. I hope you got the phone in your hand now. His number's in the show notes.
Just like India, Matty, it's one you don't want to miss, mate. Just give him a call.
He is the Tendulkar of earthworks.
I think the people who've been like a bit, trepidatious about certain commodity markets point to the growth of India as sort of filling a gap that China's demand might sort of, ease in certain areas. Is it as simple as, they seamlessly fill a gap, or, do you think you kind of have pretty substantial volatility in between where, things could get a bit dicey?
I think it's different for different commodities, right? So look, the biggest kind of beneficiary of the Chinese growth obviously was iron ore, because China just geologically doesn't have much hematite iron ore, had to rely on high cost magnetite. And that's where it just became so big on the iron ore import side of things. Whereas for India, it's all about met coal, right? India has an abundance of iron ore, has an abundance of thermal coal, albeit poorer quality, but it has next to no met coal. So for commodities like met coal, India is already the biggest importer in the world, surpassed Japan a few years ago, 70 million tons a year out of a global market of about 300 million. But India is going to double its blast furnace steel capacity by the end of the decade. So the met coal imports are going to be huge. They're potentially, even with the green steel revolution going on in Europe, North America, Northeast Asia, where companies are looking at closing blast furnaces and opening EAFs or kind of green steel basis, I still think global met coal demand grows over 20% in the next 5 years with very little supply addition. So that's where met coal is a massive beneficiary of the India story. Equally, copper. India doesn't have much copper geologically. So it's going to be a big importer of copper as well. Adani just switched on the world's largest copper smelter earlier this year, 500,000 tons a year. That's partly why copper TCs are so low, because India's taking a lot of the copper concentrates away from China this year. Aluminium as well at the moment. India's a big exporter of aluminium primary and then imports a lot of aluminium products. But again, the aluminium demand growth means they'll be consuming a lot more of that as well. So it's different story for different commodities, I think, for India.
Just on copper there, Ian, we've seen a pretty volatile year in copper prices, in part because of the changes in TCRCs and how they've just really been crunched over 2024. Have you got insight on that sort of trend? Is that something you expect to keep going for the foreseeable?
Yeah, so there's definitely some interesting things going on in the copper market this year. So normally we look at the TCs as a good lead on refined prices. And if the TCs are tight, then that means surely the refined market's going to tighten up later on, because there must be a lack of concentrate to produce the refined copper. This year, that's not quite come true, right? It's a little bit more of an issue if we had a number of ex-China smelters coming through. So we've got India, this 500,000 ton Adani one starting up. Ivanhoe started the smelter in their African project. Grasberg's been trying to start the smelter in Indonesia, although of course that's been having problems. And there's another smelter that started up in Chile this year as well. So we've only got global mine supply growth this year anyway of 2.5%, maybe 3% globally. But we've got a lot more smelter additions outside of China. And that's meant that there's just a lot less concentrate available for the Chinese market, which also has its own smelter additions this year. So that's where the concentrates have gotten extremely tight. And the TCs, spot TCs even went negative for a period. And you're like, well, how's that possible? How can spot TC be negative? So the other issue from the smelters perspective, of course, is the byproducts, things like gold, right? The gold credits for some of them, with gold prices being as high as they are. And one of the Chinese copper smelters was telling me every $100 an ounce on gold is about $10 on the TC for some of the concentrate supplies with decent gold content. So that's another reason why the Chinese are just paying ridiculously low TCs to secure the concentrate supply. So there's quite a few technical factors there, whereas this year it's been more about ex-China smelter growth having outpaced the mine supply growth. Whereas next year your mine supply growth will continue. Yes, you've still got the ex-China smelters ramping up. It's definitely going to keep TCs very tight. But it's going to be interesting going into negotiating season, because I think there will definitely have to be some changes to the kind of the idea of an annual TC or just one price agreed for all smelters globally. I don't think we're going to see that. I think the system's definitely going to break apart, perhaps similar to what we saw with iron ore in 2008-9 when that broke apart.
So one of the things we saw over the past 20 years with the growth of China was China actually signing JVs, trying to buy assets all around the world. Do you expect India to do the same?
That's a good question. I mean, they seem to have been quite reluctant so far for things like met coal, where the steel mills know they desperately need met coal, but at the same time, they don't seem willing to, I'd say, overpay for assets, right? They're still a little bit disciplined in what they're willing to pay. And they view themselves as, we're steel mills, we're not miners. We don't know how to run mines so much. So I think there's a reluctance to go upstream on that side. But then you have seen some transactions, right? You've had, was it Jindal bought the Moatize assets from Vale last year. But it's certainly a big question mark for India where they're going to get the met coal from. So one of the fascinating things last year, the Indian Steel Association sent a delegation to Mongolia. And I was asking them, well, how are you going to get the coal out of Mongolia? The Chinese will never let you rail it through China, and the Trans-Siberian is jammed with Russian commodities into the 7 East Coast ports. You're not going to get it out there. And a couple of months ago, the Indian government actually announced investment in ports in Iran with the idea that they can rail coal 7,500 kilometers northwest out of Mongolia, across Russia, down through Georgia and Armenia, and across Iran, and then ship it out of Iran into India. Wow. So you can imagine what that'll do for the cost curve, 7,500 kilometers of railing. Now, those rail lines already exist. I mean, Iran gets a lot of Russian commodities via that rail route. So it would also open up kind of more commodities from Russia into India. So yeah, they're just adding the bulk port capacity in Iran with an idea of shipping it that way.
That trade relationship between Russia and India is, particularly interesting with, like, all the reports that some of the growth in India of late has been kind of propped up because they're buying like discounted oil from Russia because no one else in the world is buying it from Russia.
Yeah. So that's where Modi's kind of treading a fine line at the moment of being everyone's friends, right? Where he says he's one of the freedom-loving democracies of the world, and mates with all the democracies, but equally, happily part of the BRICS club as well, very close with Russia, obviously from their kind of the military supplies from a budget standpoint, and then taking a lot of the Russian commodities, and I think also the Russians are quite big investors in India as well. So it's a very kind of close relationship there that's giving them cheaper inputs for the last couple of years. So whether that continues.
How do you think about the sort of bear case view on India if it doesn't materialize over the next decade?
I think so. The problems historically, like I said, was a lack of infrastructure and a lack of ability to execute, where people would have plans in India, but they just never get anywhere, right? Can't get land access, can't get approval, can't get access to power or resources or things. So those things do seem to have structurally changed, where the government's willing to encourage investment, it's willing to kind of help people get things done and making the resources and the infrastructure available. The other issue for India historically, I guess, has been the politics side of things, where politics kind of becomes a factor that gets in the way and delays things or changes and moves the goalposts continually. That's something where, on the one hand, you've obviously Modi won the election again in April and seems quite solid at the moment. But equally, putting aside the politics at the central level, the states all seem to be wanting to participate in this growth, even if the state is run by an opposition party, not one of the BJP alliances. They're not standing in the way of growth, because it seems every single state doesn't want to get left behind. That I can't be a state where I get a reputation that I can't deliver, or you can't do business here, because I'll get left behind. People will go to other states. So even when they've got political differences, they still seem economically these days to be willing to push the investment to get the ports and the roads and the rails and everything done to try and attract the FDI and the investment. So it seems on a very sound basis at the moment. We've seen decent growth rates since COVID, and I really do believe they are sustainable now.
If we move away from India now, you cover the battery or the new energy materials space as well, and nickel and lithium, obviously sort of key parts of this, both having a bit of a tough time at the moment. Why don't we start with lithium, because I'm sure most people will be keen to hear about that one. What do you make of the build out in China of how they've just expanded so quickly and being able to produce so much, and the sort of debate going forward between brines, hard rock assets, and potentially clay projects going forward?
Yeah, I mean, the astounding thing in lithium is how rapidly the Chinese have gone overseas and developed mining assets. In iron ore, they were very slow to do that, but that's because iron ore needs big, heavy infrastructure. Obviously, the actual volumes in lithium are a lot smaller. You can get away with just trucking projects. So it's amazing how much Chinese-sponsored mine supply has emerged just in the last year out of Africa and such like. Just kind of small, simple trucking, shovel projects that low capex, maybe higher opex, but they get the tons quickly. So China's been very aggressive in that investment, mainly on the private side, more than the state side. and they seem to have ensured that they've got enough supply now, and that's where the lithium market's really in trouble. So yeah, the Chinese lithium demand still growing very well. EV sales in China are up 30% this year. We've had a kind of cash for clunkers upgrade policy since April that's helped support the sales. So total auto sales have been struggling this year, but EV sales still up 30%. Now, the problem from a lithium perspective is hybrids, right? Hybrid sales were up 80% last year. Again, this year, soaring as well. So the actual lithium intensity per unit essentially has been declining, even though the headline growth numbers are good. But lithium prices have really been suffering about worries on the export demand, right, through the supply chain. EV exports, obviously, we've seen protectionism coming in, US, Europe, elsewhere. So there's worries there on the EV exports, but also the battery exports, the processed lithium exports, through the supply chain. The Chinese market players are very concerned about ex-China growth and the way that the EV sales globally have just cooled so rapidly. That's really the thing that's got everyone on the back foot, because, the Chinese have built so much capacity through the battery supply chains, and the domestic demand, the domestic EV penetration is running ahead of the 2030 targets now. It's going extremely well. But it's the Western world demand which has really disappointed this year. And that's the thing that sent the price down while the supply has been coming through aggressively.
What do you think about Rio Tinto's thesis for the Arcadium takeover about the future of brine and DLE being the big contributor to the front of the cost curve?
Oh, no, I'm not really familiar enough on that to share any thoughts.
That's all right. All good.
Sorry. Yeah.
On the copper, nickel, aluminium kind of side of the equation. I'm kind of curious to see how you what your views or non-consensus views might be, on those other commodities.
Yeah, so from the battery materials side of things, I've long said copper's my favorite, because look, we just don't know which battery technology is going to win, right? Essentially, in this kind of Betamax VHS battle, a few years ago it was all about NCM, now it's about LFP. Next year the Chinese are already bringing out solid state batteries. It's the technology has just been evolving so quickly at the actual battery level. But we know they need the cables, right? The wires in the cars and the charging infrastructure. We need mass grid investment globally for the charging infrastructure. I think that's part of the problem why EV sales have fallen flat in so many countries globally, because people are buying them and finding the charging infrastructure is just not there. That's what Western governments need to be investing in if they want to encourage EV rollout. So to me, copper is really the beneficiary, or the one to focus on for that kind of EV related demand growth. Whereas nickel is really suffering on the supply side of the way Indonesia's come in and just gone from nothing 10 years ago to this year it's going to be 2.2 million in a 3.5 million ton global market, and pushing on still another 30 odd MHP and MAT facilities coming in the next 18 months. So Indonesia's built all this supply on some of those heavy projection growth rates for NCM from a few years ago. And of course, now they've fallen flat because LFP has taken all the market share. So nickel looks really, really challenged, where, yes, we need a pain trade there. We need some of the higher cost suppliers to be sidelined. And we're seeing that happen now. But I don't think that means we start a new cycle anytime soon. I think nickel's going to be struggling all the way through next year, at least, as well. Whereas, copper's the favorite structurally, because that added demand from the EVs, from the charging infrastructure, on top of what we're already seeing on the green energy revolution, wind farms, solar panels, etc., and all the, again, wiring them into grids, and just the lack of copper mine supply growth. So that's, copper's absolutely the favorite. Nickel, not so keen on at all.
You posed the question, when a price is going to move sustainably high enough to incentivize new production or whatever the outcome might be. Have you been brave enough to put a timeline on when we see that leg up in copper prices?
Yeah, so to me, the copper prices have always been about scrap generation. So I used to have a great chart from Google Trends, where if you search Google Trends for articles about copper theft, then that used to match the copper price really well through those peak prices in the early 2010s. So it's almost like, the criminals are out there on their smartphones going, hey, LME copper's up tonight, lads, let's go rip off some more wiring. We're willing to risk electrocution at 12K, but you're not willing to risk that at 10K or something. That's really a marginal supply. I wouldn't say there's any mines in the world which are not operating at $10,000 copper, but will operate at 12,000. For your marginal supply, it's all about incentivizing the scrap generation. So that's what we're kind of running into in these coming years, where we're going to have the demand outpacing the mine supply growth. We're going to need to generate more scrap, and if we're going to need to generate more scrap now than we did last year, we're going to require a higher price to pull in those marginal scrap units. So yeah, I've got kind of view that copper prices are just continually higher in coming years. Obviously we hit the near $12,000 level back in May, when we had all that fast money coming in on AI and data centers and all that overexcitement, and that quickly evaporated. But yeah, I think that kind of pricing will be quite achievable early next year when the market's really in deficit and the Chinese demand keeps coming through and India's doing really well. And yeah, the big thing we're waiting for in commodity land, I think, is a bit of a Western world restocking.
It's an interesting way to frame it. It's like what price does copper need to be to incentivize people to steal more of it?
Yeah, that's essentially it. Yeah.
Trav mentioned aluminium before as well, so I think we'd be remiss not to talk a bit more about that, given what's just happened in the past couple of weeks with alumina prices just breaking through $600. And what we've also learned the past couple of weeks is all this fragility through the system, this sort of choke points where the whole system is very contingent on a few factors. I think the prime example is Guinean supply for bauxite. Do you think that fragility just lends itself to regular disruptions over the coming years?
Yeah, absolutely. Yeah, so we've got a much tighter global alumina market now, obviously post the Grenada closure and stuff. And yeah, like you touched it there on the Guinea side of things. So I'm wondering if this is going to become a seasonal factor, similar to what we have in the met coal market, actually, where you've got China's now reliant on imported bauxite is about 70% of their supply, and of that, 2/3 is from Guinea. So Guinea alone is about 1/3 of Chinese bauxite supply. Guinea has rainy season from May to July, so the exports are down sharply. And of course, that means Chinese import arrivals are much weaker in the third quarter, which is when China's in peak hydro season and their aluminium productions are running at record highs, pushing up to that 45 million ton production cap. So you've got a real inverse seasonality there between the imported bauxite supply and the domestic Chinese aluminium production. So when the prices spiked back in June, I was saying, well, this is going to be quite sustainable till November, because historically, when alumina prices have spiked, you've seen Chinese exports come out very quickly, because China's never really struggled for bauxite supply, has an abundance of alumina refining capacity, and was able to switch on very quickly when the price incentive was there. That's very different now. Post-COVID, both iron ore, zinc, bauxite, it's just impossible to mine anything in China these days unless you're already an existing mine. The anti-corruption, environmental rules, we've just decimated the elasticity of those supply curves in China. So there's no supply response in China on mine supply. And equally, the refineries, there's still plenty of spare refining capacity in China, but because the Ghanaian volume's not there, they weren't able to ramp up either. And with the domestic production of smelters being so high in 3Q, what they were producing extra was going domestically. So yeah, that's a problem that we have now as a seasonal trade. Could that be repeated next year, and increasingly more so going forward? That's a big question for me. That alumina could start to develop that seasonal trade. So the bizarre thing is how the alumina market's just not, the aluminium market's not followed through. If you remember 2 years ago when LME aluminium was $4,000 on the back of high energy prices, every day, the aluminium traders, LME traders are talking about, spot European power prices are up, aluminium's up. And that wasn't a real cost curve. Who's producing aluminium with spot power? Most smelters have got contracted power. They're not using a spot unit of power to produce aluminium. Whereas the alumina price is real. Even if people aren't buying a spot cargo of alumina, an awful lot of people have got contracts referencing the spot prices. So a lot of smelters globally have got to be feeling that uplift in the alumina price, and that really should be pushing the aluminium cost curve above, say, $3,000 LME basis. But the aluminium price has been very slow to move. And yeah, I just think people are not understanding what's changed. The normal answer I get is, alumina's price spikes never last long. It'll be back down again in a few weeks, so don't chase it. Whereas it's not been up now for 3 months. Like I said, it's just had another fly up in the last few weeks as well. And the risk is it stays higher now, could well be into next year. So yeah, LME aluminium, surprised it hasn't moved already. It's really lagging.
Is that the market you'd sort of pick of the bunch there that's most misunderstood? Or is there another one? That one, I mean, I think I'm a prime example, but are there other ones you think are super misunderstood?
Yeah, that's one that really stands out, and certainly for this year, just in terms of something that's changed dramatically. But my other big one is met coal, where that's structurally I'm very bullish on met coal, and equally that's got a very interesting seasonal pattern because iron ore. The nice thing about the iron ore market seasonally is that Chinese New Year, always January or February, matches the West Australian cyclone season and the Brazilian rainy season. So you have both demand and supply both weak in the first quarter of the calendar year, and then both pick up after that. Whereas for met coal, you've got India, the biggest buyer, is on monsoon season from May to September with reduced steel production. And then they come out of the monsoon season and ramp steel production Q4 into a peak in Q1, which of course is exactly when Queensland starts to suffer from all the rains and cyclones. So you've got a real inverse seasonality in met coal, where your biggest supplier out of East Coast Australia is offline at the same time as the biggest producer, India, is pushing its production to peak levels. So you've seen for the last 2 years, and again, this year looks like being a repeat, where met coal prices have been $300+ at some point in Q1 on a cyclone-induced spike. But middle of the year, they're down $200 because the Indians are suffering from monsoon season and Aussie production's back up to normal levels. So you've got a real interesting seasonality there in met coal, which I think could just get more and more extreme as the Indian demand grows and grows.
No wonder the commodity traders make so much money.
Ian, I've got one last commodity I just want to touch on, a bit out of left field, but nobody talks about it, and you cover the base space. So I wonder if you give it any thought. Zinc. Is there any reason to get excited about zinc?
Does it stink or does it smell good?
It smells good at the moment. Yeah. Zinc's had a very good year already. The price has been up towards $3,000 for much of the year, which historically is a very high level. You've seen a lot of zinc mine supply disruptions globally, right? Peru, Australia, two biggest suppliers. And again, as I said, on the China domestic side, it's something where we've lost that elasticity of domestic zinc mine production as well. So the zinc concentrates market's been extremely tight. That's really hurt the Chinese refined zinc production as well. That's the refined zinc production is really struggling because of that lack of concentrates. So yeah, in copper, they found a bit more scrap. They've managed to maintain the copper production, and they had very high concentrate inventories carrying over from last year that have helped. Whereas in zinc, that concentrate tightness is really feeding through to the refined zinc market in China. So refined zinc production's down, and China's having to import more refined zinc from the global market. So that's really tightening up the global market. And steel production obviously has suffered a lot this year. Steel's about 2/3 of zinc consumption goes into galv steel. Of that, about 2/3 is into autos. So with this Chinese stimulus, that should certainly help auto sales, appliance sales, a lot of those end-use zinc galvanized steel markets. So I think the zinc demand will be doing better in China in coming months, whereas the supply side is still very challenged. Doesn't look like that can recover until at least next year. So I think, zinc's already quite punchy today. Aluminium prices have really underperformed. They should catch up. I'd say zinc the prices have done well, but they certainly look sustainable here on a kind of 3 to 6 month view. It looks like a very tight market.
Where were the disruptions in Australia for zinc? North Queensland?
Yeah, was it Dugald River have issues or not?
Yeah,
not
Century Zinc's
100% sure.
offline as well.
Century, yeah.
Yeah.
Fantastic. Ian, I am all out of questions. I think I've peppered you with enough. Fellas, do you have any more for Ian?
Thank you so much, Ian. If there's one last thing you kind of want to leave our listeners with, something something we should all reflect on, or something non-consensus that you've been pondering, love to hear it.
Yeah, so I'd say the key thing really, and obviously India, we've got the structural growth story, and that's still very underappreciated. But as the demand keeps printing strong numbers, hopefully they'll get more and more attention. But the other thing is on the China side, that it's not just one China as it was for the last 20 plus years. It's about this split between new China and old China. And that gives very different stories for each of the different commodities.
Excellent, mate.
Amazing.
Thank you so much.
Thanks for your time, Ian.
Thanks, Ed, for that, mate.
Cool. Good stuff. Cheers, guys.
Oh, boy, JD, that's talk about bloody something that's in your wheelhouse and not mine. You love that shit.
I had a feeling you might say that. And yeah, I did love it. There was a good few details in there that I hadn't heard before. So very, very fascinating and awesome that we get a chat with these folks.
Yeah,
It's amazing how
good intro, but
yeah, good intro. It's amazing how consensus
over it, mate.
like long copper is. Everyone is super, super bullish copper. It's an amazingly consensus view.
for the last 4 years.
Yeah, but yeah, maybe it's when people are fatigued that it actually just.
When are they going to give up, Trav, and just let it go up?
Well, I also think it's so consensus in our very niche world of the market. It's like it has gone beyond that, and it did when copper ran over $5. That was like hedge funds and these sorts of characters who aren't always playing in, mining stocks or whatever. They might look at commodities more broadly, but it's a small-ish part of the world.
MMS are going to be mining a large part of the world soon, JD. Did you know that?
They are. And Grounded are going to be supplying houses for a large part of Perth. Pretty bloody
Pretty much MMS do a bit. Grounded chuck the camp in for it. CrossBoundary Energy will chuck your power station in for it. Bloody Sandvik will put the ground support in for if it is an underground mine.
CRE got you in sorted.
They'll insure the mine. Greenland's equipment will sort the water infrastructure out for the mine. K-Drill will find the mine before this happens. MMTS would have got the tenement sorted for K-Drill to go start drilling on it, and Australian Earthworks and Haulage would have cleared the site, put the dams in for K-Drill to do the hulls, and then once it's all going, you'll see how it's performing on the stock market via a spark chart.
Fantastic, mate.
Hooroo, money miners.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.